JP Morgan is not just the largest bank in the United States, but one of the most dominant and diversified financial institutions globally. My name is Jason Wu,
And I'm Arav Sobhani.
and we are investors from Langley High School recommending a buy to hold on JP Morgan Chase with a target price of $392.35, implying roughly 30% upside from its current price. This recommendation is supported by a combination of cyclical upside from capital markets activity and structural advantages that position the firm for long-term growth.
JP Morgan is currently trading at approximately $302 per share, with a market capitalization of over $823 billion, making it the largest bank in the United States. From a valuation perspective, the company trades at around 15.1 times forward earnings, with a PEG ratio of approximately 1.7, suggesting the stock is reasonably priced relative to its expected growth. In terms of risk, JP Morgan has a beta of 1.05, indicating stable performance relative to the broader market. Additionally, JP Morgan returns capital through dividends and share buybacks, reinforcing shareholder values. Overall, this reflects a high-quality company with strong fundamentals, with additional upside driven by improving capital markets activity and long-term structural growth.
JP Morgan operates in over 100 countries and manages over $4 trillion in assets. The diversification pictured reduces reliance on any one segment while maintaining exposure to high margin advisory and underwriting.
The banking industry plays a critical role in the global economy by facilitating lending, payments, and capital markets. Industry performance is largely driven by interest rates and economic cycles. In recent years, higher interest rates have significantly increased profitability, particularly through net interest income. At the same time, regulatory conditions play a key role in shaping capital market activity, influencing both merger volume and IPO issuance.
This chart shows the steady decline in the number of banks in the United States over time. This reflects ongoing industry consolidation as smaller banks exit the market or face stress, deposits and customers shift towards larger institutions like JP Morgan. This creates a structural advantage, allowing this firm to continuously gain market share.
JP Morgan operates across four key segments: consumer banking, commercial banking, investment banking, and asset and wealth management. Each segment performs differently depending on economic conditions. This creates a balanced earning structure where weakness in one segment is often offset by strength in another, allowing the firm to remain stable while still capturing upside during periods of strong deal activity. Now that we understand how JP Morgan generates revenue, we can look at the key drivers behind our investment thesis.
We rate JP Morgan Chase as a buy to hold, driven by three reinforcing factors that together position JP Morgan uniquely for both near-term upside and long-term growth. JP Morgan is the largest investment bank globally, with leading positions in M&A and IPO underwriting as well as advisory services. This chart highlights how direct regulation impacts deal activity. During Trump's first term, antitrust enforcement was less restrictive, with lower agency win rates allowing more deals to go through, supporting higher M&A volume. In contrast, under the Biden administration, the appointment of FTC Chair Lina Khan led to significantly stricter enforcement, with more deals being challenged or blocked, contributing to the slowdown shown. Now, as regulatory pressures begin to ease again, we expect a backlog of delayed M&A and IPO activity to return to the market. We are already seeing early signs of this recovery, with M&A volume rebounding and mega deals reaching all-time highs in 2025 in both total value and deal count. Early data supports this trend as well, including over $63 billion in mergers approved in June 2025 alone, signaling a strengthening pipeline. This directly benefits JP Morgan through higher advisory and underwriting fees. Given its strength as the number one firm in investment banking globally, the firm is well positioned to capture a disproportionate share of this rebound.
The second driver of our thesis is the recovery in IPO and capital markets activity. We are currently entering a major AI-driven IPO cycle. Companies such as OpenAI and Anthropic are expected to go public as early as 2026, representing some of the largest potential IPOs in history. JP Morgan is uniquely positioned to benefit from this trend. The firm has already committed over $7 billion in debt financing to support AI data center infrastructure for OpenAI in Texas, while also providing corporate banking and lending services. Additionally, JP Morgan is an investor and financial partner in Anthropic, participating in recent funding rounds. This creates a powerful dynamic where JP Morgan is not only advising these companies, but also financing the infrastructure behind them. More broadly, JP Morgan is able to finance entire industries, not just individual companies. In the AI sector, where multiple competitors exist, JP Morgan benefits regardless of which firm succeeds, because it provides capital, advisory, and underwriting across the entire ecosystem. Finally, JP Morgan's scale and diversification provide stability. The firm generates revenue across lending, trading, asset management, and advisory services, allowing it to perform across a wide range of economic environments. Together, these factors reinforce both structural and cyclical strength of our thesis.
JP Morgan's leadership is clearly reflected when compared to its peers. It has the largest asset base among major US banks at over $4 trillion, significantly ahead of competitors. This scale provides advantages in funding costs, efficiency, and client reach, while also strengthening its ability to compete for and lead large, complex transactions such as M&As and IPOs.
JP Morgan's advantages come from its size, brand, and operational efficiency. Its deposit base provides low-cost funding, and its reputation supports strong customer retention. The company has also invested heavily in technology to remain competitive. Finally, its scale allows it to continue gaining market share as the industry consolidates, while supporting long-term client relationships across multiple financial needs.
These advantages create a wide economic moat. JP Morgan's strength comes from its ability to operate across multiple areas of financial services, and this allows the firm to build long-term relationships that often extend across lending, advisory, and markets activities that allows it to be the largest bank in investment banking, as well as the largest bank in the United States.
JP Morgan is very strong in terms of Porter's five forces. Barriers to entry are extremely high due to regulation and capital requirements. Supplier power is low and switching costs are significant. While competition exists, JP Morgan maintains a strong position supported by its scale and integrated model.
JP Morgan generates over $180 billion in revenue and more than $50 billion in net income, the first US bank to do so. Earnings per share have grown at approximately 17.7% annually over the past 5 years with strong returns on equity. This financial strength supports the firm's ability to invest in high growth areas and maintain resilience across economic cycles, as shown in its fortress balance sheet. We valued JP Morgan using two approaches to increase the reliability of our target price. First, we built an earnings-based discounted cash flow model using earnings per share, which is appropriate for banks since earnings are a strong proxy for shareholder value. Instead of relying on a single estimate, we used a three-scenario approach. In our bear case, assuming a 5% growth rate, we arrive at a price of around $345, implying 14% upside. In our base case, using only an 8% growth rate, we reach $392 or about 30% upside. And in our bull case, assuming just 12% growth, driven by stronger capital markets activity, the valuation increases to $462, implying 53% upside. Second, to validate our result, we also built a free cash flow to equity model that is specifically designed for banks. Instead of using generic free cash flow, our free cash flow to equity model explicitly accounts for regulatory capital constraints by incorporating CET1 capital requirements and risk-weighted asset growth. In other words, it measures how much cash JP Morgan can generate for shareholders after maintaining the capital it needs to remain well capitalized. In this FCFE model, we assume net income grows 7% in the near term, reflecting stronger deal activity and investment banking momentum, then normalizes to 6% in the longer term, and using a cost of equity of around 8.5% and a 3% terminal growth rate, the FCFE model implies roughly 28% upside, which closely matches our EPS DCF outcome.
Key risks include a potential macroeconomic downturn, declining interest rates, and regulatory constraints. Additionally, if capital market activity remains weaker than expected, it could impact near-term performance, though this is partially offset by the firm's diversification and structural strengths.
JP Morgan is led by CEO Jamie Dimon, one of the most respected leaders in global finance. A key differentiator is the firm's commitment to a fortress balance sheet, emphasizing strong capital, high liquidity, and conservative risk management. This approach allows JP Morgan to remain resilient during downturns while supporting long-term risk-aware growth, directly reinforcing the durability of our investment thesis.
JP Morgan has committed over $2.5 trillion to sustainable finance by 2030 and aims to align its portfolio with net zero emissions by 2050. It also invests in community development, financial inclusion, and maintains strong governance practices. Together, these initiatives strengthen JP Morgan's long-term positioning and support sustainable growth.
JP Morgan is also leveraging AI over 400 use cases to automate operations, enhance fraud detection, and deliver more personalized client insights, improving efficiency and strengthening its competitive advantage. Additionally, the upcoming wave of AI-driven IPOs presents a key growth opportunity for JP Morgan's investment banking revenue, directly supporting our thesis.
In conclusion, JP Morgan combines industry-leading scale, diversification, and strong financial performance supported by both structural growth drivers and cyclical upside from improving capital market activity. With a balanced and durable investment thesis, we confidently recommend a buy to hold. Thank
Thank
you.
you.